Hi guys, welcome back for another video with Stock House Academy. Alright, so in this video we're going to share with you what are the different kind of valuation methods you can use to actually help you to value what the company is before you decide whether it's a good time or is it a good price to enter, right, and add this company into your portfolio. Right, so before you actually watch this video, if you have not watched the earlier video, right, please click on the link above or below in the description, actually link back to the first two videos to watch that first before you continue on this, otherwise you're going to be lost. Alright, okay, without further ado, let's jump right in. Okay, so alright, before we get started, just a quick one. If you are on this channel and you have not subscribed to our video, please click on the subscribe button, alright, and the bell button beside it, alright, okay, to get you notified on the upcoming videos that we're going to post in the future. Quick disclaimer, whatever we share here, avoid method we share here is actually based on my own experience, how I use it, how I applied it. Please do your own due diligence. If you need to, speak to your own financial consultant before you actually do any form of investment. Alright, okay, so this is going to be the part 3, alright, of the 4-part series on fundamental and technical analysis, and today we're going to delve deep into another topic of the fundamental analysis, which is the valuation method. Alright, so how to actually determine how to value a company and why is it important to value a company? So in the earlier two videos, we find out what kind of company we are looking at, alright, and we are looking at the numbers itself to tell me whether companies are actually making money, are they profitable in the long run. We want to invest in good company, but when is the time to invest it? And that's where we want to find out what's the valuation of the company and compare that with the stock price to determine whether at that price point is it a good entry point. Basically, there are 6 different kind of methods, and I'll run through you with them. There are actually more different kind of valuation methods that are used. It's just that these are the 6 ones that I learned, that I know of, and I actually applied them, using them to look at companies. So here we go. The first one, the valuation method. The common one actually you use is called the PE ratio, right? So basically the formula is taking the price of at that point of time when you're looking at this, divide by the earnings the company is earning at that year. This actually basically just give you an idea and indicative that if every dollar that you have invested, how long does it actually take your investment to return, to break even, right? So for example, okay, let's say the share price at $10 and the earnings is actually at $1, it roughly will take you 10 years to break even on this investment. Okay, so likewise, if a company is at $20, the earnings is at 1, it will take you about 20 years. So these two will give you a ratio P of 10 and P of 20. Of course, we like to have low PE, i.e. to say that the lower the PE, the better. Right, taking US market as a reference, right, the average PE for US market is roughly about 15. Okay, and when it was high, we usually gauge it about roughly about 20 PE. So the lower the PE, the better. So with the lower PE, actually give you an indicator that at that point of time, the price is actually pretty low enough in terms of PE ratio. Whatever capital that you have invested, it takes you a shorter time for you to actually make back your investment, which is actually a good thing for investors because we want to make our money back as soon as possible. Right, so this is the first valuation method that we use. But do take note, right? Okay, some of the companies are generally on a higher PE per se, right? Particularly because the nature of their sector. For example, like the technology sector or the healthcare sector, right? Their PE are generally a lot higher. Most of the time are above 20. So if you're going to find anything below 20 around there, usually that will constitute a pretty undervalued. So this is something that you need to delve deeper on to find out whether that's the sector of the PE generally high. For PE ratio, generally I use it for growth company, right? I'm looking for them to actually grow a lot bigger, a lot larger in the future. The second method is actually we use the Pdg method. Basically, using the same formula of the PE ratio, actually we compare that by dividing it over to the growth rate of the company, right? Because the PE itself sometimes may not tell you anything. Like I mentioned earlier, right, certain sectors like the technology or the healthcare sector, the PE are generally high. So that is why we want to compare it with the growth rate, right, to find out based on the PEG itself, relative between the PE and the growth, is it actually comparable on a healthy level. A good example, let's say if a PE and a growth rate of 2%, you're just telling me the PE growth is at 5. If compared to a company, let's say you have a PE of 20 and you have a growth on an annual compound rate of 20, you tell me the PEG is 1. So we actually want to look at company with a lower PEG as well. For PEG, we are also using on company that are actually on a growth basis. The method 3, this is a calculation model. Basically, we call it a discounted earning model, in short DEM. right? Basically, this is actually a complex mathematical formula. Basically, you need to plug in the figures of the earnings, of the revenue, basically on the shares, and do a 10-year or even 15 years projection out into future with certain discounted rate, okay, to find out what is based on the current earnings, what is the estimate earnings of the company in the next 10 years if they're going to grow on the same rate for the next 10 to 15 years. Okay, once we get that, actually we discounted it back to today's dollar value. Okay, what is the actual price, potential price of the share itself? And then from there, we actually do a comparison with the projected price of the share and current share price. Is it above or under value? Because of the complexity of the formula, it's very hard to actually explain it on this video. So I'm just going to give you a rough definition of it. We use it for growth because we want to find companies that are having very strong or rather consistent increasing earning potential. The next method will be the discounted cash flow earning models. Alright, this is very similar to the earlier method, discounted earnings model. Right, they are actually applying on the same similar kind of mathematical formula. It's just that one comparing it based on earnings, one comparing based on cash flow itself. Same thing, I will not drown into it because it's too hard to go in depth in detail of running this calculation formula itself, right? But generally, just need to take note that why sometimes we actually use discounted cash flow models over discounted earning models is if you are actually doing a valuation for small to mid cap companies, right? Sometimes the companies may not be earning as that well because they are a smaller company. They're probably still quite a relatively small startup. The thing is, the company has been actually very profitable in terms of generating revenue, generating cash flow. It's just that their overhead expenses or expansion expenses are still very high, right? So, but they are actually generating very good, healthy cash flow. So this kind of company, sometimes we will use this valuation method, the discounted cash flow model, use it as a projection to find out how much the company's earnings, the earning potential in the next 10 to 15 years of the company based on the cash flow itself, right? So if you have seen companies that are actually, you know that they are very strong fundamentally, they are doing very well, but then in terms of the earnings itself, they are not seem very good, but you know that they a lot of money actually spending on expansions and things like that. You might want to use this model, discounted cash flow model, right, to calculate what is their intrinsic value, right? So likewise for discounted cash flow model, we actually use it for growth companies. The fifth method they are actually use is this thing called price to book value. Alright, okay, this is usually used to assess companies that are actually very asset rich, right? Because certain companies, they have a lot of assets. For example, developing companies or companies actually run buildings, offices, malls. You know, they actually own this kind of infrastructure. They are actually considered assets to them, and a lot of these assets are not appreciate values over time. Investors are actually looking to invest in their assets, not so much looking at whether the company will grow in the long run, but rather buy into the value of this asset. Okay, because when share price actually plunge for whatever reason, it may go below the book value of the company itself. So basically, what the book value means that if a company were going to liquidate at that point in time, how much return per share a company is able to get out of it. Just to give you an example, let's say a company actually have a PE of 0.5. Basically, it means the company are actually paying 50 cents for every dollar of the company book value. Right, so these are the times that where investors like us who actually buy into the company assets, we actually want to look out for using the PB, price to book value, to actually revalue such companies. These are the kind of companies I term as using for asset play. Just looking at the assets of the company itself. Okay, last but not least, the sixth method. Okay, this is basically called the dividend yields. For investors who are actually invest into the dividends of the company. So you just take the dividend that will pay out for that year, divide by the current share price, and what's the yield you're going to get. Typically, you will want to look for company with a dividend yield of at least 5% or higher to make it justifiable and reasonable for investing in such dividend yield company. Right, one disclaimer to take out note. If you are investing in a US company that are actually paying out for dividends, to take note that such company actually has 35% withholding tax is something that you need to take note. Alright, so as I said, there are actually a lot more valuation methods. This is just a six basic one that I personally use and touch on. If you are a more in-depth financial guy, if you talk to a lot of like investment bankers and stuff like that, they have a lot more different complicated ways of actually looking at it. But for beginners, I think these are the good 6 valuation methods, good enough for you to use to kick started in your investing journey. Quick summary. Okay, so basically here are the 6 valuation methods that we use to look at. So the first one is the PE ratio. The second is actually Pdg, PE to growth ratio. Right. The third one is the discounted earning model. Similarly, on the fourth one is a discounted cash flow model. So if I'm going to evaluate a company based on the assets, on the book value, I will actually use this P, price to book value, in short PB, alright, to actually use it as an asset play valuation method. And last but not least, if I'm investing a company into its dividend yield, I will use just the dividend yield method. Alright, okay, to actually evaluate the company to see whether is it a good entry price to enter at that point in time. Right, okay, so that's it. Right, so these are the 6 basic valuation methods you as a beginner investor could use to start evaluating on it. I hope you like these 6 valuation method. Alright, if you have any comments or anything else that you want me to know or share with the community, please comment on the link on the comment section below. Right, let us know how you feel. Right, if you like this video, please like and thumbs up on this video. Alright, of course, not forgetting to actually click on the subscribe button to subscribe to our channel for more upcoming video in the future. Alright, so with that, I hope these valuation methods are useful for you. Right, and see you and watch out for the next and then the last part of this trading series. Right, see ya.